Andrei Jikh is a YouTuber.
That's Andrei Jikh,
who invests in dividend-paying stocks and currently has a Robinhood stock portfolio worth over $202,000. Way to go, Andrei! No, seriously, that's awesome. But what if Mr. Andrei Jikh were to take that entire stock portfolio, sell it off today, and invest all of it in real estate? Would he be better off? We're gonna explore that right now. Hi, it's Jay. And here we talk about personal finance, real estate, and other gems that can make you money. That's right, folks, we're sharing the wealth.
Subscribe.
Hang on, I'm gonna try to become Andrei Jikh. I really wanna get inside of his head for this video and ask myself, would I be better off if I sold my entire Robinhood portfolio and instead invested in real estate? And by the way, I know my Andrei Jikh impression is not very good, but don't worry, my magic tricks are on point. He's got nothing on me. You ready? Okay, whatever you do, do not play that back in slow motion, or you'll know that it looks even worse than it did in regular speed. I basically have no skill with this deck of cards, but hey, if you want to give me an A for effort, it would mean the world to me if you would just take a moment to hit that like button down there. Alright, it's clear I'm no Andrei Jikh. The man is very talented. I don't think anybody would deny that. In all honesty, I'm a big fan. I think he has a great channel, and his Robinhood portfolio is just crushing it. I'm gonna throw a wild prediction out there. I actually think at some point, Andrei Jikh is gonna have more subscribers than Graham Stephan. I know. Now I like Graham Stephan too, so don't beat me up. Just throwing it out there. It's possible. Stranger things have happened. So check out his channel if you wanna learn a lot about dividend stock investing. I'll just say I know a thing or two about real estate. I think real estate investing is a great vehicle to build wealth. And I realize it's not for everyone. There are some pretty significant hurdles. There's a high barrier to entry, that down payment that you gotta come up with. Although in some cases with the right loan, you might only need 3.5% down. But that begs a whole different question, how much skin in the game should you have? Do you really only want 3.5% down? Maybe not. Ideally, you're gonna put 20% down. That's really the best position to be in. The last thing you wanna do is buy real estate and then end up upside down. But in addition to the down payment, and the closing costs that you have to pay when you go to purchase real estate, it's expensive. It is nowhere near as passive as investing in the stock market. That's not to say you can't put a lot of work into investing in the stock market. There are people who really babysit their stocks, but in general, real estate is going to be a lot more work. The initial setup to get cash flow from real estate going is a ton of upfront work. You gotta find the property, you gotta negotiate the right price, you gotta deal with agents and lenders. You gotta get approved for the loan. You gotta close the deal. You gotta do repairs. You gotta have a contract. You gotta find a tenant. Then even from there, you have to collect rent, and there's ongoing maintenance. And I know all of that can seem overwhelming, but if you think about using your money, your goal is to have each dollar work for you and make the maximum return. I think there's no better vehicle than real estate. The concept of leverage is incredibly powerful, and that really comes into play when you're dealing with real estate. Being able to put just 20% down, but earn the full appreciation on 100% of the asset, that is powerful. Yes, it does come with more risk, but as your risk increases, so does the potential for greater reward. What I really like about real estate is that there's actually 4 ways to make money, and we're gonna do a whole video just talking about that, but just real quickly, cash flow. That's the money after all expenses are paid that come into your pocket every month. Appreciation, the value of your property may and probably will go up in the long term. Principal pay down. Each month as you're paying your mortgage, you're also paying down some of the principal on your property, which is adding to your net worth. And the last one is tax savings. Even if you turn a profit, the way the tax laws are set up, in some cases you can show a loss. And the tax benefits from real estate do give you a pretty big tax advantage. So those are the 4 ways. And there's actually a 5th way that I like to sneak into the conversation, and that's inflation.
Inflation. Inflation's bad.
Yeah, not everything is great about inflation. But if you owe money to a bank, just in terms of that amount, inflation is good for you. Why? The value of the money owed reduces over time. In essence, it becomes easier and easier for you to pay down that mortgage. And also, inflation causes rents to rise over time. So you earn more and more rent over time, and it becomes easier and easier to pay down your loan. That's sort of a 5th way to make money on real estate. A lot of people don't mention that one, but I don't think it can be ignored, because I guarantee you by the time you're into that 10th or 15th year of ownership, you're gonna be making more rent than you were in that first year. Now I know investing in the stock market has its own set of benefits, and the real estate equivalent of cash flow with stock market investing is dividends. Companies will pay you a dividend on a schedule for your ownership in that company. Stocks also do appreciate. There are plenty of stocks that are great when it comes to growth. Unfortunately, the best growth stocks usually don't pay any dividends at all. You can get your Apple or your Disney that kind of walk that line, a little bit of growth, a little bit of dividend. But as far as I know, there aren't any stocks that are super high growth and really high dividend. If that exists, I'm not aware of it. If you're aware of it, let me know down in the comments. So that's another nice thing about real estate, is that you can actually have property that appreciates and also has great cash flow. And I don't care what anybody says, it is possible to get both. You can buy an expensive home in an expensive area that's going to appreciate a lot and still get a bunch of cash flow. And if you don't believe me, check out the video I made where I share the remodel and all the financials of a recent buy and hold investment purchase that I made. With all of these benefits of real estate, let's just make a hypothetical scenario where Andrei Jikh says, you know what? I'm done with dividend stock investing. I'm ready to get my hands dirty and I want to invest in real estate. I don't know what that voice is because that's not at all how he sounds. But you know, we're working with it. Okay, so we got to set up some ground rules here. The first thing is that we're only going to look at real estate cash flow. And in Andrei Jikh's situation, we're only going to look at his dividend payouts. Certainly real estate can appreciate, and certainly his stocks can also appreciate. But we're going to take that off the table for now so we can have more of an apples to apples comparison. I just want to see which vehicle would return the best cash flow for Andrei. How can he get the most bang for his buck?
It's the great showdown. Dividend paying stocks versus cash flowing buy and hold real estate.
In a recent video, Andrei revealed that he has a total stock portfolio value of $202,000. He also revealed that in the most recent month, he got a total stock dividend payout of $824.50. Certainly nothing to scoff at. But it's been a rough month. Left and right, companies are cutting dividends, and his portfolio is very heavily tilted towards industries that really aren't doing that well given the current economic situation. So we'll give him a little benefit of the doubt. For this exercise, let's just round him up to $1,000 a month. Congratulations, Andrei. You got a raise. We want to make this adjustment because the world is a little crazy right now, and we want to level the playing field a little bit. Certainly if the world were normal, he would be making a lot more money. So I think it's fair to round him up to an even $1,000. Now from there we can do the exercise and see what happens. So the first thing Andrei Jikh would have to do is he would have to sell everything in his stock portfolio. Bring that Robinhood account down to zero. Which, by the way, I've done that a couple of times to buy real estate. Sell! Well, let's just assume Andrei Jikh sells everything. Now poor Andrei, he's gonna have to pay some taxes if he sells his stocks and has some capital gains. He's had his portfolio for a while, so he probably has a mix of short-term and long-term capital gains. And certainly a big portion of it is probably his initial investment. It's really hard to say where he will end up without knowing the minute details of his portfolio. But let's just go a little bit aggressive and say that he gets hit with a 20% loss. 20% gone, boom, right out the door to taxes. We'll just say that he's left with $160,000 to invest in real estate. I mean, he would probably have a lot more than that left over, but we want to err on the side of caution just to see how this pans out. I'm from NorCal. I know about Northern California Bay Area real estate. Jay from the Bay. So in this scenario, we're gonna have Andrei buy some NorCal real estate. It's a little bit more expensive than some parts of the country, but I think we can get him a pretty good deal on a property for about $350,000. There's definitely some parts of the Bay Area where a 3-bedroom, 2-bath house can be found in rentable, good condition for $350,000. Obviously, we're gonna have to make some assumptions here, folks, but I'm trying to be very fair about it. It's the only way we can make this go head to head. In all actuality, things could actually be way better for him with real estate, but we're making some assumptions to be cautious and try to be really fair about this. Now, we could have Andrei leverage up and buy a whole bunch of properties, 5% down, but we're not gonna do that because we know Andrei's a really smart individual and he would never do that. He knows it's very wise to put 20% down on your properties. So that's what he's gonna do, which is gonna let him buy 2 properties. So let's start calculating our numbers. What we're gonna do is we're just gonna calculate the numbers on one home all the way through, and whatever we end up with, we'll just multiply it by 2, because Andrei's gonna buy 2 of the exact same home, or at least very similar.
I like to use a great calculator by Zillow. It's called Zillow Mortgage. It's the tool I use whenever I'm trying to analyze a deal and figure out what my monthly payment is gonna be. It's very accurate. And it will let you calculate your monthly payment and include PITI, which stands for principal, interest, taxes, and insurance.
Given the current interest rates, which are incredible right about now, I think it's perfectly reasonable to expect that Andrei Jikh could get about 3.3%. And with 20% down on a $350,000 purchase price, Andrei would be paying $70,000 down payment. So if he puts $70,000 down on 2 properties, that's going to be a total of $140,000. But remember, we said he would have $160,000 left over if he sold all of his stocks. So you might be wondering, well, why does he have $20,000 left over? Shouldn't we get something more expensive? It's okay, because there's going to be closing costs, there might be some reserve funds, he might need a couple of initial repairs. We don't want to budget him all the way to the last dollar. So the first thing to know is that a 3-bedroom, 2-bath home in this area could certainly command a rental price of $2,500 per month. And we already know that the mortgage payment each month is going to be $1,573, and that's for PITI, principal, interest, taxes, and insurance. All of that paid in one payment for $1,573. So we're going to take the $2,500 a month in rent and subtract the $1,573. $2,500 minus $1,573, and that leaves us with $927 per month. That's our monthly cash flow on one property so far.
Cash flow! Woo!
But we should probably deduct a few more things out of it. When you're calculating your numbers to assess the value of a potential rental investment property, there are a lot of things you should consider. It's not a best practice just to look at your payment and the amount of rent you think you'll get and stopping there. In general, you should probably account for vacancy and future repairs when you're evaluating a rental property and looking at the numbers and really trying to see if they make sense. Now, I own 9 buy and hold real estate investment properties here in this area, and I can tell you vacancy is really not a thing. There's almost no vacancy. Just to be cautious though, let's at least calculate a 2% vacancy. Because vacancy is essentially lost rent, you want to calculate this number based off your rent amount. In this case, it's pretty easy. We know the rent is $2,500. We can multiply that by 2% and get $50 a month. However, if your rents are not consistent throughout the year, for example, if you purchase a property and you know you're going to be raising the rent, you'll want to calculate your annual amount of rent, and then you divide that by 12 to break it back down to your monthly amount. I know, that might seem like a lot of math, but don't worry, we'll go through it together real quick. Let's break out the whiteboard. So we already know the rent is $2,500 a month. So if we multiply that by 12, that gives us $30,000 a year, or $30,000 annually in collected rents. And then to figure out what 2% of $30,000 is, we just multiply $30,000 by 0.02. And that gives us about $600 in vacancy losses annually. And to get a monthly number, we just divide 600 by 12. And that comes to about $50 a month in vacancy losses. So remember, we had $927 of cash flow so far. So we're just gonna subtract $50 from that, and that leaves us with about $877. But we're not done yet. We should reserve a little bit of our money each month towards future repairs. When you own a property, it will need repairs. Things can and will break, and you're gonna have to pay for them. So it's always wise to set a little money aside for these repairs. Sometimes people call these capital expenditures. Now, there's a lot of strategies that landlords use to figure out what the right amount is to save for repairs. But if it's a new property and you don't have other properties to compare it to, you're gonna have to just kind of come up with a number that you think makes sense. In this case, we're just gonna take 1% of the total value of the asset. So the purchase price of this property was $350,000. So 1% of $350,000 is $3,500. That gets us to roughly $292 per month. I know that sounds like a huge chunk of change to set on the side, but it's always good to plan for the worst and hope for the best. So if we take our $877 that we have so far per month and subtract $292, that leaves us with $585 of pure sweet cash flow every single month from this one property. So let's figure this out. If Andrei Jikh has 2 of these, he's gonna have $585 per month times 2. That would be $1,170 per month in real estate cash flow. And remember, we gave Andrei $1,000 per month in dividends. So I think we're there. I think real estate's better. It's a win for Andrei. But wait a minute. Let's think through this a little more. Andrei is used to dividend stock investing, which is very passive. In a scenario that we just made, it's not exactly apples to apples. Because in this scenario, Andrei is managing the properties himself, which means he's taking every phone call, he's dealing with the tenants, he's placing tenants, he's evicting tenants, all the needs of the property all going through Andrei. Now, what if Andrei wanted to have a similar scenario in real estate where it was completely passive? Well, that's possible. you could hire a property manager. So let's see how those numbers work out. I think a fair price that a property manager would charge is about 10% of the rents per month. And we said the rents are $2,500 per month, and 10% of that is $250 per month. So now we're just gonna take that cash flow that we had and subtract $250, and that's gonna leave us with $335 per month in passive income cash flow for one property. So let's multiply that by 2, and that gets us to a grand total of $670 per month. 670 is less than 1,000. All things considered, for a relatively equal experience with respect to how passive an investment is, Andrei is actually doing better in dividend stocks. I made the rules, I ran the numbers, and these are the results. All right, so let's sum this up and put this into perspective. I think that what we've discovered here, in terms of monthly cash flow alone, is that if Andrei is willing to put in the active energy to manage his own buy and hold real estate investment properties, he would actually fare better every month by about $170 per month with real estate. That's $2,040 per year better than what he's doing now. However, if he wants the same passive experience that he's probably enjoying now, then it seems like he's doing the right thing after all. Ultimately, there is no right answer. There's a million ways we could spin this. For example, if he was spending all his time managing property, maybe he wouldn't have as much time to make such wonderful YouTube videos that we all enjoy. I don't think anything here, though, should be taken as a rule of thumb. The truth is, either method for investing could work very well given the right strategy and a little bit of luck. Alright folks, that's all we've got for now. If you appreciate videos like this, be sure to hit the like button and subscribe. Wait a second, did Andrei just spend all of his money on a 2020 McLaren 570S?